All right. Good morning, everybody. So I think it's gonna be a kind of slow week to start things off with the market sitting in a tight range, waiting for news. We have FOMC this week. That's considered a volatility suppressor. I know the first time I heard that, it didn't make much sense to me since we know on FOMC days, we see really big moves. But as we get closer to FOMC, the market will very likely hold in a tight range and chop sideways while we're waiting on that data. And that's why it's considered volatility suppressing. Volatility is a nerd word for movement. So if we quit moving and we're going in a tight range, then we have low volatility. That doesn't necessarily reflect in the options prices, though. It's a completely different thing. So Japan up 0.75% and the Russell down 0.25%, and everything else is kind of scattered in between. NASDAQ also in the red with the Dow and the S&P flat, reflecting that hurry up and wait bias with just no pressure to go anywhere. Today we have factory orders. We also have additional auctions in 2 time frames. But if you have one, you just go ahead and assume you have the others. So at 11, 11:30, and 1 o'clock, just expect to see those auctions. What's listed is 11:30 and 1 o'clock. So we're pretty much done with ECB, Elderson. Then we've got those auctions. Once we're done with the 3-year, that's pretty much it for the day. I don't expect much out of this loan officer survey. I mean, it's always possible that we get something, but not expecting it to be too impactful, really. Everything's going to come down to hurry up and wait. All right, we can see the average daily range. Considering where we opened it last night. Wow. It's a bit much. Yeah, there we go. Consider where we opened last night, and we've already hit the edge. 21-day average daily range is at 1% right now. That's 58 points basically. So we could move, 29 points in either direction. But really, if you look at where we're at, we're basically flat, right? Because we opened, gapped down, came back up, got the gap closed, and now we're basically where we were Friday at the close. So we haven't gone anywhere. This is one of those occasions where the ADR is a little misleading. If we're back up where we came from and we've already hit the ADR, then it implies we haven't really gone anywhere at all. So while we generally use the ADR and we say, okay, if we've hit one side early enough, we can go to the other side by the end of the day. Well, yeah, definitely that holds true today. But I wouldn't consider the idea that we've already made our move when really all we've done is come back to where we ended on Friday. From here, if we look at that ADR, we could move, 29 points this way, 29 points that way. That'd be the ADR half. Or we could move, 58 points in a single direction to the upside or the downside, and that would be the ADR full. SPY and the SPX will have a more accurate ADR today than the ES does. The base case argument is sideways, so we're really not expecting to do much. Stay inside of Friday's range, and if we do break out of it, then we're expecting to come back in again. Now, news can change that, right? If we get really bad news or really good news, we can break this range and we could run. Sure, no argument from me. But it would have to be some sort of surprise news, something that's not on the docket already that we already know about. It would have to be catching people off sides in a gotcha kind of moment. So with that in mind, this is the range that we want to focus on. So we can see the floor pivot, the smaller channel down here. The pivot is lower than yesterday's pivot. That's considered bearish. Price opened underneath the channel. That's also considered bearish. We had an 80% chance of hitting the channel, which we've already done. Now breaking our own pivot point here, it's very likely that we retest the RTH low and maybe come back down and test our own Globex low. That still wouldn't put us in a bearish bias, really. Wouldn't get negative unless we broke through Thursday's low or Friday's Globex low. We're underneath the weekly channel and the weekly pivot point. A wide channel implies that if we break out, it won't stick. Well, that's a weekly channel. So we're talking about if we break out on the week, it likely doesn't stick and it comes back in again. Just keep in mind, these channels don't make price do anything. It's just a reflection on what we could do if we break out. We left the point of control of last week up at the highs, 58.70 area. This is a classic double D profile. We wouldn't look at it as a capital B. It's two different Ds, with the upper D having the point of control. So if we can leave this lower distribution, then we've got to contend with that should we get back up there. Not expecting to do that, right? We don't have any reason to believe that we're going to break Friday's high and be able to begin working our way up through those levels. To be able to get to that point of control, we've got last week's midpoint, 58.11 cog line. And we can see how price responded to that 58 area. There's a lot of liquidity right there. When we came into 5,800, they just sold it out. Overshoot 58.02. So a lot of drama up there. We've seen these weeks with FOMC where We think it's going to be sideways. It starts out kind of slow, and then we just run up, down, doesn't matter. And we've got a lot of examples of this. So, mark out your range for the week and expect that we're going to come back in. But if we get through the 1, 2, 3, 6 on that range and we continue to go, don't fight it. Just go with it. Plan A and plan B, right? If we're planning for it to stay in the range and it gets past the 1, 2, 3, 6 and continues to go, well, then we're wrong, right? So flip it over, take the other side of the trade. Don't continue to fight it. That might sound like some obvious stuff, but you'd be surprised at what we consider obvious. All right. We've got the 10-week underneath us again, 57.50 area, 3-week overhead, and the 10 and the 20 overhead. So for any sort of rally to the upside, that 3 weeks going to be a significant fight to get through. Then Friday's high, that pivot point that we marked out, round number, 57.92 cog line, 58.11 cog line, 10-day, 20-day, a lot of stuff up there we'd have to fight to get through. Underneath this, we've got 57.32 cog line and the put wall, 57.34. Now, these put walls are supposed to act a little bit like support, and it's where we would expect to see some monetization of the options, see price stop falling, maybe just kind of hold the line, get a little weaker, but we expect to see defense at these levels. So if we just cut right through it like it isn't even there and continue to expand to the downside, then they've flipped, right? You can see the spot gamma's trace map nowadays where we can watch the intraday dealer gamma unfold in real time is kind of wild. And we go through these zones of positive and negative gamma, dealer gamma. So if we get down there and we break that put wall and we really begin to expand, then, we could see 5650, 5600. Volume's looking good. It's in the 84, 85 area. The 1, 2, 3, 6 that I had mentioned, just pick yesterday's low, yesterday's high. There's your 1, 2, 3, 6. So if we get below that, then it's game on to the downside. Right? Same thing up here. If we get above that, then we start running it to the upside. Otherwise, as long as we don't get through that, that is the range. We can add to that, by the way. Take something like SPY. Here's your 1-day estimated move, 575. The downside 1-day estimated move, 567.5. That lines up pretty close, except for the upside. It doesn't even project us being outside of Friday's range to the upside. We're still inside the range. Same thing for the ES. There's your 1-day estimated move, 57.80. And down on the bottom side, call it 5,700. but it's based on that gap down, which I'm going to argue that's going to mess a lot of people up today. Ten-day, 30-minute volume profile. The TPO and the point of control on the volume profile, they're lined up really well. And they're not perfect, but it does demonstrate all of that resistance overhead. A lot of trader's remorse, so to speak, if we were to try to go back up there. We would need to spend probably another week at this level down here to really build it out enough to bring that point of control down. So I wouldn't expect that to move anytime soon. On Friday, we wiped out that VPOC that we had drawn from Thursday's level. It's done now. We don't need it. And we don't have a new one, because if we were to mark Friday, well, we've already passed through that level. So it doesn't hold any weight for me. I think the profile this morning really highlights, even though we have that gap down and the run back up, this really highlights a significant range. It's interesting that this point of control wasn't down here, right? That it didn't open down here, find like an iceberg or something and get brought back up again. It opened down there, ran up into a lot of volume and stopped there, or a lot of liquidity and stopped there. All right, we evaluated this week's range on Friday. Remember, it wasn't really all that different than our current week, but it is now. Now, this indicator, every once in a while, it can do something a little weird. So when you see the range this wide, you have to be a little concerned that maybe the indicator isn't acting right, right? So we want to check that. Now, there's a couple of ways we can do it. We can use the Thinkorswim think back. So we can go back to Friday and see what the level was at that point at the close. Or we can just look at what it is now. So if we're looking at Friday's range, it's 150 points. That's plus or minus from our current location. So that's pretty wide, right? You can see how it's significantly higher than everything else. And it's not curving back. Say like if that was an earnings event, how you'll find one that's really high and then it dips back down again on the other side. We're not really seeing it dip back down again. This says 220 points to the upside, and I'm going to assume it's another 220 to the downside. Yeah, give or take them, because it's balanced, right? It's what it's supposed to be. So if we closed on Friday with it reading 220, then we got this really, really, really wide range. And then between Friday and now, it dropped from 220 to 150. I find that hard to believe. It's more likely that the indicator's acting a little silly, and a 150 move would be 59.11 to the upside and 56.11 to the downside. That seems like a more normalized, and it would still be big, right? Compared to what we had last week, it would still be big for this week. There's no argument with that, but there has been times in history where this thing has been off. And if you set the chart back for a couple of years, I mean, look at that one. Obviously, there was something wrong here, right? Or here. So there's been times where this thing has, just been broken. There's nothing we can do about it except recognize that sometimes we just got to draw the levels by hand. When the indicator doesn't work, get your levels from here. Use Friday's expiration. Now you can use the think back and see what it was Friday at the close, or you can just mark it this morning. It's 150 each way, and you're good. We're back to the start of the 10 week, as we talked about last week. So from here, we could move a good 2.5%, 3% in either direction. It's been a while since we've been 2.5% below the 10 week. We really don't have any reason to believe we're going to see that kind of move either. So it would have to bring something really bad, not FOMC either. It'd have to be something else, something news related or shock and awe the markets couldn't see, caught off sides, mispriced. Other than that, we should hold the line around the 10. This was a good digestion. And then transition back into another bullish wave, or we get a little weak like we did back here, right, in the later part of 2023. All right, for the 10-day, we're less than 1%, so around 0.75%, but we're still underneath it. So any run to the upside, we're going to have to deal with that 10-day moving average. It very likely will act as a resistance. But if we've expanded far enough away from it and we begin moving towards it at this point, it could be a gravity point. It'll bring us into it and we'll just chop around it for a while, build a band or a range, and then leave the 10. We are on the way back up. And while that isn't always, a guarantee, we can be on our way back up and still drop back down again. Generally speaking, when we're on our way up, we're looking for that next leg, right? Like a wave. So getting back to the 10 would be a good start. Bitcoin, nat gas, uranium, all down this morning. VIX, bonds, China ADRs, gold miners, precious metals, energy, all up this morning. And we got some semiconductor that is up, not all of them. SMH is still under the weather. So we got to get a little more out of that. It's very much going to be a stock pickers market today, right? And probably for the week, at least the front part of the week. If the indexes are going sideways, generally 80% of the market's going to go sideways. Whether or not we see that, we've had over the last, say, 5 weeks or so, a lot of stocks making some great moves, right? So we don't have any expectation of the indexes making some moves today. Might as well put our focus into something that is going to move. Commodities, equities, something. Pot stocks are also up this morning, but I'll put some caution into that. It's just a little algo print at this point. We're not seeing any real flows there. Solar also is up, but same thing. It's just a print. We're not seeing anything coming in with it. No flows. Bonds gapped up, but I mean, it's got to hold it, right? It's been chopping and digesting down here and just really not going anywhere. I think we've all been expecting that run back up, and we just keep not getting it. Silver, gold, precious metals. I mean, we got to get out of Friday's range. Sure, it's up this morning, but if it can't get out of that range, then it isn't going to matter. So focus on Friday's range, not just in the precious metals, but basically in everything. China ADRs, Baba, Baidu, JD, PDD, all those guys tried to get a Friday inside day breakout already and having a hard time with it. If they can get out of that, we could get a little something out of it. Just remember, China is still not in play yet. That big meeting is in March. So, there's a lot of time between now and March. Semiconductors, and they're looking a little better, but we need 0.5% at least, and we don't have that yet. So get that inside day breakout, focus on Thursday's range, get the expansion from there. And just remember, we're really not looking for the markets to do much. So if the indexes aren't doing it, it's very likely that 80% of the market won't do it. %10 of the S&P is down 0.5%. 9% of the S&P is up 0.5%. Not a lot of edge there either direction. For the NASDAQ, 10% is up 0.5%. And 13% is down 0.5%. Now, Intel got the smackdown because it's getting removed from the Dow, and NVIDIA is getting added to the Dow. So is Sherwin-Williams, I think. So Sherwin-Williams getting a little lift. So this isn't going to do it, right? If you're going to see a good move today, at this point, it's not looking like equities are going to do it. We're going to want to see 0-day levels in the S&P or the NASDAQ lift up. If you're looking for some sort of rally in the indexes, it's going to have to come from 0-day or from news. All right, so you got the levels. We got to get outside of Friday's range. We're not expecting to do that, by the way. So if we test the edges, I'd expect to come back in unless news sent us to the edge. Watch the clock. Be careful.